Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, July 5, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And so we had the day off yesterday. Monday was a very light volume trading day. Today is generally what we call a holiday hangover. There's not a full array of traders and investors back to the markets yet. Around the 4th of July holiday, especially when it falls in the middle of a week, a lot of folks will take the remainder of the week off. However, what we're doing here in terms of the pattern that's developing in the Spider is potentially a bearish pattern trapped underneath the 20-period moving average. Now, you guys by now know the routine. As long as we get above and stay above on a daily chart closing basis, I'll move this over if I can. There we go. We have to get above and stay above on a daily chart closing basis, 243.72, which is obviously over and above the 20-period moving average, and then would be a close above this red candle high. That would be positive for the market, and that will likely promote higher prices, potentially even new highs. On the flip side of that, if we do not get above that high on this red candle here, then this pattern will generally promote a move to the downside. And it looks something like this. You have this sideways consolidation pattern, and then likely scenario is you get another down move, and that would at minimum of test the lows from over here and potentially lower. But it's a little early to tell. With light volume this week, I'm going to favor the upside. And what happens a lot in these type of cases where you have a pattern that looks like this and you're contained with some overhead resistance with the 20-period moving averages, you may find a gap higher in the morning. A gap higher over and above the 20-period moving average would be the first and earliest sign that we were going higher and that we would in fact close a day above the high of this red candle here. So that's basically where we are with the Spider. And the bigger picture is we're getting closer to the real time zone that I think this market is going to make a character change and a trend change for a more extended period of time, likely into the fall period. If I'm right on that, the likely story is that we're going to see a turn occur. The earliest, a bona fide turn, the earliest around the middle of July, which is not that far away from where we are now. It's a week or so away. And it could extend out to around the August 9th or 10th area in that zone. But the fact that we've seen a pickup in market activity, a pickup in volatility over the last couple of weeks is really the shot across the bow, in my opinion, of what's really coming down the line. Nothing happens overnight. The market at highs typically does not make a spike lower. It typically has what's called a rolling top. And we're sort of seeing a rolling top develop right now. So you have a top that develops like this. You take another run at it, potentially make new highs, and then the market finally rolls over. And that's generally what we're going to see, and that's more of what my expectation is. We could certainly see, for example, a down move out of this bearish pattern. We could see a lower high put in around that time frame in whether it's a week, 2 or 3 weeks from now. Any of those scenarios are possible. What we want to do as investors and traders is right now be on guard. I'm certainly going to let you know when I see the signal or the sign that the reversal is at hand. There's a number of different ways that I can determine a sell signal in the markets. We haven't seen any yet, but when we do, when and if we do, I'll certainly bring it to everyone's attention. Have no fear. We don't have it yet. There's nothing wrong with the market yet. And just to display that point, let's go over to the weekly chart. As long as we're above the moving averages, which are trending higher, then there's nothing wrong with this market. So what we've seen here is we've seen the up move, and with the weekly chart, you can see here that we're just going sideways. And we made a run for this low here at 240.75, pierced through it a little bit, bounced off of that level, and this move or this pattern will generally promote higher prices coming. And I do still think there's an opportunity, and I think it's even more of a probability that we do see new highs before this market is ready to roll over and correct in earnest. Now, right now, we're in the third week of going sideways in this upper range near the highs. So potentially, for example, we could get a spike higher next week to new highs, and it could be a blow off top. It doesn't have to go extremely high, but it could be a reversal at that point, that next week or even the following week. We'll see. I'm just speculating at this point, but I'm watching it very closely, and right here, right now, all I see is a bullish pattern that will generally go higher. All we're going to do is trade or invest in the markets that are in front of us. One thing you never want to do is impose your will on the market. Let the market tell you what its intentions are. All we have to do is follow its direction. Now, the IWM today did diverge some from the S&P. We were down about 0.5%. We were down earlier, or we were down more earlier in the day. As you can see here on the right side, we came in to test the 20-period moving average and bounced off that pretty nicely. But when you pull back the curtain and you look at it from a longer-term perspective, so we were down 67 cents today, and at the end of the day, there's nothing wrong with this market either. We're above the moving averages on the daily chart, and we're trending higher. And if you go over to the weekly chart on the IWM, it's much of the same story that we just discussed on the spider. We have an up move, we're going sideways, and this will generally promote another move higher. And that's what we see right now on the charts. So nothing wrong with the overall markets from the bigger picture. Yes, we did have somewhat of a divergence today in the IWM, but with light volume and many of the participants in the markets today still on vacation, we're not going to make a federal case out of the divergence. We're just going to note it, and we're going to move on. Here, when we look at the transports, you can see that the transports made a new high on Monday, and we're basically flat today, up 6 points. That's more of a rounding error than anything else. But remember what we discussed several days ago. You had this big down move, this red candle, and then we started going sideways in a bearish wedge pattern. And we discussed at the time, any close above this negates the bearish pattern, and the energy will be released on the upside, and that's exactly what we saw. So there's nothing wrong with the transports. It's a strong market. This market is telling us, as a whole, it wants to go higher. And when I say that, it's not limited to the transports. Yes, the transports may want to go higher as well, but probably needs to consolidate for a few days first. But overall, the markets across the board, at least from a look perspective, want to go higher. They're just not ready to roll over yet. We need to respect that and let the market tell us what the intentions are. Now, looking over at the gold market, what we did see on Monday was a thrashing in gold. It was taken out behind the woodshed, and we had discussed many times that the longer gold was to consolidate over that trend line right here. So we had down move, we had sideways consolidation, generally promotes another down move. We had a lot of overhead resistance here with the moving averages, and what did we get? We got the down move that we were expecting. Now, as far as today goes, gold was up about $6.50. However, I think it's just a dead cat bounce. I'm not convinced that gold is finished going down yet. Therefore, we're going to wait for a better signal. We did get volume today as compared to the recent volume in gold. It was a decent volume day, but it really wasn't definitively a bottom in my opinion. So I'm going to let it fall, and potentially we'll put in another bearish pattern, and that will promote lower prices. It's just not telling me that it's bottomed yet, so I have no interest in owning gold on the long side. I'm going to wait for gold to let me know when it's time, if it's time to buy the metal. Nothing to do, just let it fall. When you look over at silver, silver was down today, and silver took a thrashing on Monday as well. We talked about the $16 level. We even pierced through that, and now it's fought back to 16. That's an important level. It could be trying to put in a bottom, but I need more evidence. We would need to see where the actual close comes in for the day, which will happen in a little while from the time I'm making this video. And if it closes with, for example, a doji candle, which is possible, maybe not probable at this stage, there's not that much time left. Then we would be looking for a retracement and we would have something to trade against. However, I'm not convinced it's a bottom yet either, although it was on decent volume, but it just doesn't have my attention at this stage of the game. I don't think it's a high probability trade to the upside. Therefore, when I feel that way, I just leave it alone. More interesting today was crude oil. Crude oil got taken out behind the woodshed, down over 3% today. We were originally discussing, or I was originally discussing, $46 as the shorting level, or the level at which crude oil should stall out. We went higher. They made an attempt for the 50-period moving average, didn't quite get there, and had a nice reversal today, piercing through on the downside the 20-period moving average and bouncing off that. But it was a big down day for crude oil. Let's see where it goes from here. Is it going to go sideways? If it goes sideways, that would be putting in a bullish pattern. And if there's more downside coming, we would see some follow through tomorrow. And by the way, from the pivot high to today's low is slightly more than a 50% retracement. And the retracement is from this pivot low right here. See if I can get that line straight. To this pivot high from today. And we retraced about 50% of that move. Slightly more than that, and that's where we bounced off of. That's normal and common market behavior. And by the way, for the time being, we just very well may have a low put in here in crude oil, and we may not breach these lows, but I need more evidence. I need more information in order to get on one side or the other of crude oil. Let it put in some kind of a pattern over a few day period of time, and that'll give us more evidence or an indication of what's to come. Right now, let it play out. Maybe it puts in a bullish pattern, and that will promote higher prices. But the fact that we had a pretty good down move off of that 50-period moving average, or just short of the 50-period moving average, is an interesting move, and it's not, in my opinion, just a garden variety pullback from the 50-period moving average. It was a little more meaningful today, and we'll see what happens over the next couple of days. Right now, no trade in crude oil as it stands. Looking over at the bond market, on Monday we came into the 50-period moving average. Today had a little bounce off that level. We'll see if this is going to hold or not. I am still thinking that there's an opportunity to get up to that 159 level, maybe 158 on the lower side of that, 158 to 159. We'll see if this is a garden variety pullback. You have the 200-period moving average down here. This is going to be your last line of defense if it's got one more leg higher at all. And as it goes for bonds, it was very similar to crude oil. From this pivot low here to this pivot high here, this is about a 50% retracement. Comes into the 50-period moving average, 50% retracement, right around the scene of the crime that's in here. So it made sense that you're going to find some level of support and a bounce at that level. We'll see if it's sustainable, or we put in a bearish pattern, or it just takes off from here. One way or the other, we're going to let the bond market dictate to us what its next intentions are. And just as a point of interest, from pivot high to pivot low on Monday, that was day 6. This is day 7. It stands to reason that on day 7, sometimes day 8, we get that reversal or bounce in the other direction into a support area. That's exactly what we saw here. And again, not a bond market lesson. It's just a chart lesson. We found the pivot top, or we found resistance. Market goes down from the pivot top for 6 days in a row into a 50-period moving average, into a zone where there's a lot of support. We had a consolidation point and a breakout. This is known as the scene of the crime. The bond market came back to check in at the last, or this breakout point, I should say, and now we have a little bit of a bounce, or at least for the time being, some chart support. That's garden variety, normal market behavior. And the dollar, again, long and wrong in the dollar, making an effort to bounce up a little bit higher. We have this trend channel that we've been working with for quite some time. We had what I've called before, even before it got to this level, was a throw under. If we got to the top side of the trend channel and we peaked above it and failed, that's called a throw over. Down on the bottom side of the trend channel, when we pierce through it and quickly reverse back into the trend channel, that's a throw under. So we'll see if that's meaningful. If it is, we should begin to work our way higher. If it's not, and this is really a weak dollar, then we're going to have to go lower, and obviously these lows down here won't necessarily hold. Right now, we're okay. We're back in the trend channel. Generally speaking, when we get back in a trend channel, that's the market's way of telling you that that trend channel is important, and the fact that we got back in it should generally promote higher prices. Long term, still bullish the dollar. Short term, and very short term, it looks to be, and I can build a case for this is an up move, and we could begin a sideways consolidation pattern. If that's the case, another 2, 3, 4 days like this, and we could make a run, if not before, for the 20-period moving average, and then ultimately up to the 50 and the top of this red candle, which is going to be an important level for the dollar to take a stand one way or the other. And basically, folks, that's everything I have tonight. It's everything I intended to discuss. So with that, I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.